Warren Buffett recently invested more in Stor Capital, but what is Stor Capital all about? Today I'll show you why Stor Capital had an amazing annual growth rate of 217% since they started in 2012, and you will learn all about their financials, dividends, the company itself, their future prospects, and of course how to value their business. Hi, this is Tom from the Dividend Attitude Show. Today is going to be an interesting episode as we will dive deep into Stor Capital and how they differ from other REITs and why I recently invested in Stor Capital myself. First, what about those lovely dividends that you and I love as dividend investors? The current yield has been above 5% in the last few months, but it is still at a juicy 4.4%. Later on in the valuation part I will show you whether that indicates under, over or fair value. Stor Capital has been raising their dividends for 6 years now, so that passes my personal threshold of 5 years. With dividend growth rates of 7.3% and 6%, that also passes my threshold of at least 5% annual dividend growth rate. Although the latest raise was understandably lower due to the current health crisis. But what is telling about the recent dividend raise is that Stor Capital was even able to raise their dividends in the midst of this crisis. But as we can see here, the dividend growth rate of Stor Capital has been considerably higher compared to its REIT peers. For REITs, the earnings and free cash flow payout ratio don't make much sense. Instead, it is better to look at adjusted funds from operations or AFFO payout ratio, which stands at a proper 79%. This is not problematic since REITs are required to pay out a large sum of their profits and the revenue stream is very reliable. And again, their AFFO payout ratio is among the lowest in its industry, meaning the dividends are very well protected. There's at least one reason for concern though. And that is the Simply Safe dividend score of 50, which is a reflection of the reduced rent collection and increased risks surrounding the financial health of tenants. So I'm pretty satisfied with the dividend profile of Stor Capital, therefore it earns the first check mark. If you liked the video so far, don't forget to crush that like button and make it turn blue. If you enjoy videos like this, consider subscribing. Right off the bat, we can see here that Stor Capital has had amazing growth rates all across the board. The revenue grew 217% annually since their listing in 2012, from a mere 39 million to 0.6 billion, which is quite astonishing. For comparison, that is already over 1/3 of the revenue that Realty Income has. Important to note is that the recorded revenue is up about 3 million year over year compared to Q3 2019, but not all that revenue, so rent, is collected. As we can see here, the rent collection is now up to 90% and is highly correlated to the number of locations being open. As expected, the movie theater industry, the black line, is suffering the most, as it is the only impacted industry that still has a very low rent collection in Q3. Movie theaters represent about 3.9% of the total rent for Stor Capital. Stor Capital had a gross margin of around 98% and just below 55% operating margin. But margins don't mean anything without some context. So let's look at some similar companies to see how Stor stacks up. Right away, we can see that Stor Capital has the highest gross margin, which is great. The operating margin is actually very close, with only National Retail Properties having a significantly higher operating margin. Funds from operations, or FFO, equivalent to net income for normal companies, also grew very fast since 2012, as you can see. The reason that the adjusted funds from operations, equivalent to free cash flow, is lower is because I only have AFFO data since 2014. Even during the third quarter of 2020, they still grew the AFFO by 10 million compared to Q3 2019. Financials look good as well, so another checkmark for Stor Capital. Before you invest in a company, it is imperative to know what the company is all about. That is why I will show you some of the key aspects of Stor Capital. Stor Capital focuses on single-tenant operational real estate, or Stor. That way they have a better view of how individual properties are performing, because in most cases big investment-grade tenants don't provide profit and loss statements per location. Stor Capital deliberately focuses on tenants that have a credit rating below investment grade. Instead, they create investment grade net lease contracts to their non-rated tenants. They do this by really researching their tenants, the industry they are in, and comparing it to local rents. The portfolio diversity of Stor Capital is already rather large, with investments in 49 different states and over 500 different tenants for a bit over 2,500 properties. So an average of only 5 properties per tenant. Besides that, they focus on real estate which can be bought at a discount to their net asset value, meaning they bear less risk when the location doesn't perform well and they need to sell the property. During the current health crisis, it is interesting to see if this strategy of having less investment grade tenants means they are able to collect less rent than their REIT peers, with more investment grade tenants. As you can see here, the rent collection numbers, about 90% for Stor Capital, are a bit lower than some of their peers. But that seems to be more correlated to their tenants being insensitive to the current health crisis than anything else. The strategy and the advantages Stor Capital earns from that are one of the reasons why I decided to invest in Stor Capital, so it earns another checkmark. Since a REIT operates as a big landlord, it is important to know what their tenant base looks like. The top 10 of the tenants of Stor Capital are listed here. And as you can see, most are unknown names and not the big store chains that, for example, Realty Income has as tenants. This gives Stor Capital more room for negotiation of the rental contracts, as these tenants are more dependent on the services of a company like Stor Capital. So Stor Capital is able to create investment-grade contracts with non-investment-grade tenants. But not all investments of Stor Capital turn into a success. As a recent commenter pointed out, take this abandoned amusement park in New York, for example, which Stor purchased in 2016. Unfortunately, despite several adjustments, the tenant couldn't make it profitable and the park closed down in February. The state of the park has deteriorated significantly since it has been plagued by trespassers and vandalists. But Stor is in talks with a group of investors who want to take over the park and hire the firm to get the park cleaned up. Stor Capital faces competition from other REITs, most of which I've already mentioned. Realty Income, National Realty Properties, Agree Realty and EPR Properties. Since Stor Capital is doing quite well on several benchmarks compared to its competitors and their customer base is very diversified among industries and number of tenants, Stor Capital earns another checkmark here. It is always important to know how well a company can fend off competition to keep growing. In other words, if they have a sustainable competitive advantage or moat. The sustainable competitive advantage of Stor Capital lies in their ability to offer superior and innovative real estate solutions to middle market tenants under triple net leases. Their knowledge of the REIT industry and their ability to thoroughly research their tenants and their environment is also what gives Stor Capital an edge over competitors. Stor Capital is the market leader in profit center net lease solutions. I'm always looking for companies with a wide moat and Stor Capital definitely fits that bill. Just as important is the quality of the management. And boy, does Stor Capital has management quality. Starting with their CEO, Christopher Volk, which has co-founded Stor Capital in 2011 and has taken Stor Capital from a company with just 39 million in revenue to a company who generates 600 million in revenue in 2019. He's very well known in the commercial real estate industry and is a frequent speaker at conferences. What intrigued me the most is that Christopher Volk also posted a few articles on his view of Stor Capital and the current environment on Seeking Alpha. Something which I've never seen a CEO do before. The management team as a whole has invested over 20 billion in 10,000 different properties and has navigated multiple economic downturns. Stor Capital is also a thought leader in publishing research about their investment philosophy. Fun fact, check out their own YouTube channel, where they have multiple videos in their Stor Capital Academy. With their vast experience and the transparency of their CEO Christopher Volk, Stor Capital definitely satisfies what I'm looking for in the management of a company. So now that we know a bit more about Stor Capital, let's look at some financial ratios to get a grasp on the financial health of Stor Capital. Normally I would favor a debt to equity ratio below 0.5, but you always have to look at the industry itself to determine what the proper debt to equity ratio is and when a company is over-leveraged. The REIT industry is a capital intensive industry due to the purchase of many assets. Nonetheless, it is also important for a REIT not to have too much debt, leverage, on their balance sheet as well. Stor Capital has a debt to equity ratio of 0.81 in 2019, which also improved from 0.91 in 2012. The free cash flow of Stor Capital is covering their upcoming debt maturities by a wide margin, and they don't have any big amounts of debt maturities coming up until 2026. As I prefer to invest in companies with good debt management, this looks very good to me, and is one of the reasons I invested in Stor Capital. The current ratio measures the ability of a company to pay off its short-term current liabilities with its current assets. Stor Capital has a satisfying current ratio of 3.58 in 2019, which is actually on the lower end of their 7-year average. Based on the third quarter result, the current ratio is about 3.45. Similar to the current ratio, the quick ratio measures the ability to pay off the current liabilities by now only looking at the most liquid assets, such as cash and short-term investments. The current assets of Stor Capital are apparently all liquid assets because the quick ratio is the same as the current ratio at 3.58. However, the quick ratio in the third quarter of 2020 dropped significantly to about 0.68 due to a big decrease in cash. The same thing happened in the third quarter of 2019, so that is something to look into further. Overall, the health of Stor Capital also looks good, so another checkmark is earned here. Then let's look at the return on equity. Stor Capital has a return on equity of 6.82, but this is on the higher end of their 7-year average. Stor Capital has a 5.3 return on invested capital, which is again on the higher end of their recent historical average. Because REITs need debt to grow, it is more important than common companies for REITs to have a good credit rating, to have access to cheap debt. Stor Capital has an S&P credit rating of BBB, which is investment grade, so looking good there as well. So on this front it is looking good as well, although the credit rating is quite a bit lower than realty income, for example. So what does the future hold for Stor Capital? Which growth catalysts do they have to sustain their dividend growth? After this we will be looking at valuation to see if Stor Capital is still a buy. Stor Capital continues to focus on the US middle market, which is a $3 trillion market opportunity. Of course, Stor Capital won't be able to capture the whole market, but there is definitely a lot of opportunity for Stor Capital to further expand their asset base. Analysts on Finbox are estimating an AFFO per share of 2.04 at the end of 2022, which would only be an annual growth rate of 1.66% based on the 1.99 per share of 2019. With REITs, growth comes from two different aspects. The first one is rent increases or rent escalations. Stor Capital expects to grow by over 5% internally through rent increases and reinvested cash flows. The other growth factor is the acquisition of new properties. Since 2018 they have expanded their property portfolio with over 300 properties and they have increased their number of tenants by almost 100 in the last 3 years. Even during the third quarter of 2020 they kept on acquiring new properties. And their investment opportunities or investment pipeline is still a healthy $12.4 billion. As an investor I find it reassuring that Stor Capital is still able to keep growing their property portfolio, because these are the times where good deals can be made for the future. Another checkmark is earned here. And then the valuation of Stor Capital. According to the dividend yield theory, Stor Capital is just around fair value, with a fair value at $32. So there's not really a margin of safety right now. Undervalued would be around $23 or 6.2% dividend yield. Finbox has the fair value of Stor Capital at almost 27, which is a downside of 18.4% and a very high uncertainty due to the current environment. Stor Capital has a price to forward FFO of 18.1. Compared to its peers, it is in the middle, with realty income being slightly more expensive and Degree Realty being the most expensive. So unfortunately, Stor Capital does not look like it is undervalued right now. Contrary to most of my purchases, which I do when a company is clearly undervalued, I will buy more of Stor Capital if it stays around this price though, because I believe the company will continue to grow and overcome the current environment. So the valuation earns half a checkmark, since it is not undervalued right now, according to multiple methods. I hope you enjoyed this deep dive in Stor Capital, and if you did, I strongly encourage you to watch the comparison video I made with realty income, which you can now click on here in the bottom right corner. Also consider supporting my channel by subscribing if you want to stay updated on future content. Until next time, bye bye.